Hey, what's going on, savers and investors? I hope you're all having a great day as always. If you're new here, then welcome. My name's Griffin, and on this channel, we speak about all things investing, from specific company analysis, stock market news, and real estate. So if you're looking to grow your wealth through investing, make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release new content. In today's video, we're going to be revisiting one of the many audience favorites here on the channel, being dividend stocks, in order to get you some income flowing into your portfolio, which frankly is a long overdue video. So we'll actually be going over two individual stocks today that are both characterized as being dividend stocks here in Canada, and they actually both operate in the financials industry, which is one of the commonly known industries here in Canada to provide high dividend income, along with the utilities industry. And by the way, if you're still looking to open up your very own brokerage account in order to start investing, then make sure to check out one of the two links down in the description, where you can open up either a Questrade or a Wealthsimple trade account and get some free money simply for doing so. Before going any further here, I'd also like to mention that we have already covered so many individual stocks on the channel, from dividend stocks to growth stocks and pretty much everything in between. So if you're new to this channel, make sure to go back and check out my previous content after watching this video, because we have covered some truly great positions that could be highly beneficial for your portfolio. With that said, I really hope you enjoy the content of today's video. If you do, please make sure to drop a like. It really helps the channel grow. And on that note, let's get into the first dividend stock to watch. The first financial dividend stock that we're going to be covering in today's video is one that you've most likely heard of before, actually through their subsidiary company, being Equitable Bank, EQ Bank for short. And this is a company that was founded in 1970 and offers a variety of different financial services to both retail and commercial customers in Canada. In fact, I've even spoken about EQ Bank previously on the channel when speaking about some of Canada's top high interest savings accounts, with EQ Bank's Saving Plus account being at the top of the list. Now, this is a company that's actually categorized as being an alternative lender instead of being an actual traditional bank, and they offer services such as high interest savings accounts, tax-free savings accounts, RRSPs, as well as GICs and other financial services. Regarding their loan products, Equitable Bank offers residential mortgages, commercial mortgages, home equity lines of credit, construction loans, and the list goes on. I chose to include Equitable Bank in this dividend stock to watch video because this isn't a company that I would have included in my overall banking industry comparison video. However, I still wanted the audience to be aware of this alternative lender due to the fact that it offers a nice dividend distribution, nice room for growth, and some nice value in the industry right now. We'll be digging into all of this shortly, but let's now first take a look at their stock quote. As of close on Thursday, September 17th, the stock price was trading at $79.56 per share, which is down 0.40% in the trading day. However, the price point also still remains down around 29.14% since February price points, as it's had somewhat of a difficult time recovering, like most financial stocks in Canada. The market capitalization of EQB is currently $1.337 billion, with a highly discounted trailing 12 months price to earnings of only 7.30 and an even more impressive forward PE of 6.12, which is very low. Their trailing 12 months earnings per share are also quite high at 10.90. In contrast to this, the Royal Bank of Canada has a forward-looking PE of around 11.40 and a trailing 12 months EPS of 7.78. So EQB is definitely in a better financial position in terms of their ratios than most of these other Canadian banks. Now, what about Equitable Group's dividend? Because after all, this is a dividend focused video. Well, upon first glance, with a dividend yield of only 1.85%, this could very well deter some investors that are looking for a 4 to say 6% dividend yield that is typical in the Canadian financials industry. That's not to say though that an almost 2% dividend yield isn't still attractive, because in my opinion it is, when combined with the fact that this company is trading at a forward-looking discount. It is also growing extremely quickly and has a very low dividend payout ratio. In fact, EQB's dividend payout ratio is the lowest in the entire industry at only 11.03% of the trailing 12 months of earnings, meaning this is a company that could very well increase their dividend over time, which they will, but they are also retaining most of their net earnings for growth and expansion of the company, which we'll be looking over when speaking about their financial statements. And finally, this is a company that is categorized as a dividend aristocrat in Canada, with a dividend growth streak of now 9 consecutive years and a 5-year dividend growth rate of 14%, which is phenomenal. And last but not least, their price to book ratio is only 0.94, which is incredibly low, meaning you're buying into their assets for extremely cheap. Alright, so now that we've had a chance to look at the company's stock quote and relevant information, let's dive into their income statement and balance sheet to see what's going on from a financial standpoint. Starting with the income statement, Equitable Group has total revenues of $518.204 million over the trailing 12 months, which is actually the highest the company has ever reported. And when looking at annual growth year over year, we can see extremely consistent growth in revenues and net earnings, which is always something that I like to see. From a quarterly standpoint, revenues during 2020 have been basically untouched, even considering everything that's going on, so a very good performance. And also consider that this is even with the company accounting for provisions from credit losses of $8.8 million in Q2 and $35.7 million in Q1. Also in the income statement, I'd like to bring your attention to this row right here, which is the basic earnings per share. And as we can see consistently year over year, this figure is increasing, meaning the company is generating more net income per share out in the public. This tells me the company is increasing their net income without excessively diluting shareholder value along the way. So the income statement for Equitable Bank is looking very nice year over year, but let's now take a look at their balance sheet figures. Starting with their cash position, Equitable Group has actually managed to increase this figure quite substantially from Q1 2020 to now $569.688 million, which is really nice to see during this period of economic uncertainty. Now, their total assets, meaning a combination of cash, investments, and in the case of a lending company or bank, all their outstanding loans, this totals $29.957 billion. Their total liabilities, meaning mostly bank deposits, are $28.457 billion, and I'd like to remind everyone that this is completely normal for banks or this type of alternative lender to have such high liability figures. What is most important to look at though is their CET1 ratio, which divides the liquid assets of the bank by their total assets, giving us a percentage figure. This CET1 ratio is really important for a bank or alternative lender in this case, because considering the fact that their loans are considered assets, the total assets figure kind of means nothing when assessing how financially strong a bank is if it were to enter a difficult financial position, because it's not like they can go out and cash out their loans to customers for instant liquidity. Basically, the higher the CET1 ratio, the better. Make sure to remember this for the rest of the video, since we'll be revisiting this ratio with another stock. EQB's CET1 ratio is extremely high compared to the industry at 14%, which is higher than any of the large Canadian banks. All in all, Equitable Bank is definitely a stock to at least keep on your radar for some nice dividend income as well as future potential in share appreciation. Based on growth estimates from analysts, the company is expected to grow by roughly 24% annually over the next 5 years, so definitely don't sleep on this one. Alternative lending is becoming increasingly popular in Canada, and EQ Bank is definitely a forerunner in this industry. Moving on now to the second stock in today's dividend stock video. This is a bank that I actually failed to include in the industry-wide comparison video that I made a couple weeks back, and it is the Canadian Western Bank, ticker symbol CWB on the Toronto Stock Exchange, and this was a company that was founded in 1984. To be honest here, this is basically a bank like any other that offers retail as well as commercial banking products and services to customers, mostly however in Western Canada. As we can see here on this map, they have 2 locations in the GTA, and then their other locations are all in the Western provinces such as BC, Alberta, and Saskatchewan. Like other banks that we've spoken about on the channel before, CWB offers a variety of different accounts from checking, savings, corporate, US dollar, youth, joint, basically any account type that you could think of, CWB offers it. Now in terms of their loan products, they also offer residential mortgages, corporate mortgages, personal loans, auto loans, credit cards, and the list goes on. In addition to this, the Canadian Western Bank also offers life and disability insurance products as well as some investment focused products such as TFSAs, RRSPs, RESPs. I think you get the point here that basically they offer all the types of products that a typical bank would carry. So with that introduction out of the way, let's now take a look at CWB's stock quote. As of close on Thursday, September 17th, the stock price was trading at $27.43 per share, which is down 0.83% in the trading day, and the stock price remains down around 18.61% since February price points. The market capitalization of CWB is currently $2.413 billion, with a somewhat discounted trailing 12 months price to earnings of only 9.46 and an also low PE of 9.62, which again is among the lowest within the Canadian banking industry. Now, CWB's trailing 12 months EPS are a bit low at only 2.90, but we'll try to discover the root of this cause, which may be as a result of their high provisions for credit losses. Now, what about Canadian Western Bank's dividend? After all, this is a bank stock, so they must have a nice yield. Well, we're currently seeing a 4.19% dividend yield, resulting from a $1.16 dividend distribution per share. This places the bank's dividend right in the industry average for Canadian bank stocks. And what's most impressive here is that they have a dividend growth streak of not 5 or 10 years, we're talking 28-year dividend growth streak, which makes it one of the top dividend stocks in Canada for guaranteed income. And interestingly, it would also be categorized as a dividend aristocrat in the United States, also exceeding the 25-year dividend growth streak threshold. In addition to this, their dividend to payout ratio is considerably low at only 39.31 based on their trailing 12 months of earnings, which further solidifies their ability to continue with their dividend growth streak into the future. This also happens to be among the lowest dividend payout ratios of all the Canadian banks, which we analyzed fully in the 7-bank stock industry comparison video that I highly recommend you all watch after this video. Finally, their price to book ratio is only 0.87, which is incredibly low, meaning you'd be buying into their assets for extremely cheap while the financial market is still taking a beating. Now that we've had a chance to take a look at CWB's stock quote as well as speak about relevant information about the company, let's now take a peek at their balance sheet as well as income statement. And if you're enjoying this video up to now, please take 2 seconds to drop a like on the video. Starting with the income statement, Canadian Western Bank's total revenues are of $881.673 million over the trailing 12 months, which once again is the highest that this company has ever reported. And when looking at annual growth year over year, we can see extremely consistent growth in revenues and net earnings, which is always something that I like to see. From a quarterly standpoint, revenues during 2020 have plateaued a little bit during the first and second quarters of the year, but we're seeing now an increase once again in Q3 here, and they are bolstering their provisions for credit losses. This is great performance from a revenue standpoint, and even their net income honestly is very reasonable considering that they were putting aside considerable amounts for provisions for credit losses, which you should know all about and understand now since my previous videos on bank stocks. Now just quickly here, I would like to bring your attention to this section of the financial highlights where we can see that $200.7 million in revenue for the quarter was derived from interest income, while only $25.7 million was derived from non-interest sources. This means that 88.6% of this bank's income for the last quarter was derived from interest payments, even though we're currently experiencing an extremely low interest rate environment. I'll be honest, this isn't necessarily something that I like to see here, since the bank is highly exposed to fluctuations in interest rates and defaulting on loans. Basically, if there is a wide-scale loan defaulting wave that materializes over the coming year or so, this bank would be highly exposed to this disaster. With that said though, one thing that I've mentioned previously that does give me more confidence is the fact that industry-wide, all the Canadian banks have been lowering their provisions for credit losses up to 80% quarter over quarter. This could mean a variety of things, but tells me that these banks are optimistic about the future of the market environment. Essentially what I'm getting to is that I prefer seeing CWB have less of their total income being derived from interest, but based on how things are trending, most likely this won't turn out to be an issue. With the income statement and now out of the way, let's take a look at CWB's balance sheet. Starting with their cash position, Canadian Western Bank has actually seen declines in their cash position over the past couple of quarters, which isn't a favorable scenario, but at least they're not bleeding from declined revenue and net income figures. This does, however, have an impact on their CET1 ratio that we'll be speaking about shortly. With that said though, they do have a justified reasoning for this decline in cash position, being that on June 1st, the bank completed the acquisition of 100% of the common shares of IA Investment Counsel Incorporated, which is an investment counselor operating under the brands TE Wealth and Leon Fraser and Associates for a total purchase price of $87 million, all paid in cash. TE Wealth and Leon Fraser and Associates provides financial planning and wealth management services targeting high net worth Canadian families, and this acquisition contributed $6 billion to assets under management and administration at July 31st, 2020. So basically, they bought another company all in cash, which will be beneficial in increasing their future income though, so this doesn't necessarily bother me. Now, their total assets, meaning a combination of cash, investments, and in the case of a bank, all their outstanding loans totals $33.222 billion. Their total liabilities, meaning mostly bank deposits, are $30.088 billion, and once again, this is completely normal for banks to have such high liabilities because deposits count as liabilities and they can leverage these bank deposits into new loans. What is important to look at is their CET1 ratio, and CWB's CET1 ratio is actually quite low at 8.8%, making it the lowest of all the Canadian banks, but let's remember that this is due to their temporarily low cash position as a result of purchasing the wealth management company all in cash. Over the coming quarters, as the bank increases their cash position, so will their CET1 ratio. With all this financial information covered, what are my final thoughts on the Canadian Western Bank? First of all, as with most Canadian financial companies, this is a bank that is trading significantly below its February price point, now translating into a very nice trailing 12 months price to earnings as well as forward-looking price to earnings ratio. The bank's growth over the past 5 years has been very nice, and I'm quite confident that over the coming 5 years, we're going to be seeing CWB increasing in share value quite a bit because right now it is trading significantly under what it is actually worth. Based on analysts' growth estimates, the bank is expected to grow at an 11.70% average annual growth rate, which is very nice to see. And finally, the dividend yield of Canadian Western Bank is very nice at roughly 4.5%, which is great for any dividend portfolio. And in future bank comparison videos, I'll make sure to include CWB because it definitely has its place, especially more than Laurentian Bank at least. So what are your thoughts on both of these dividend stocks that we spoke about in today's video? I'd love to know, so make sure to let me know your comment down below. And while you're down there, please make sure to drop a like on this video if you enjoyed the content. Once again, make sure to check out my portfolio of videos already posted on the channel. And if you want to learn more about dividend stock investing as well as other investing topics, make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release new content. On that note, thanks a lot for watching today's video speaking about Canadian financial dividend stocks, and I'll see you in the next one.